take issue with that in any way.
Well, they certainly can. I mean, that's always a problem right now with dollarization in most countries. There's a lot of rules that kind of try to stop it or prevent it. It's a lot harder to stop stablecoins than confiscating currency that people may be hoarding in their bedroom. It's a little harder to take it off the blockchain and the internet.
Okay, let's talk crypto more broadly now, beyond stablecoins. The Fed working with the private sector, as we talked about the history of the Fed, same thing, goes back to 1913. This is what the Fed is supposed to do, work with the private sector in this country. But now we have this new, rising, emerging class of assets in this country, crypto assets. And how do you see that, crypto more broadly, beyond stablecoins, interacting with the traditional banking sector?
Well, I think in the crypto world, I focus on things in the crypto world that look like payments. The other objects that might have properties that look like a commodity or may look like a security, those are out of my remit. Those are things that would have to be dealt with by other agencies. So I don't spend a lot of time thinking about how to do things with those types of assets. I only worry about payments that look more like bank deposits, if it's a payment instrument. So that's the stuff I'm particularly interested in. But in the crypto world in general, many people have heard me say, but I think of the crypto world is always, there's three buckets. There's an object that's being traded, there's a technology for doing that trade, and then there's a technology for recording the history of that trade and proof of that trade. Now, when you go to the grocery store and you buy an apple, the apple's the object. You pull out your credit card, there's a reader, you tap it. That's the technology for doing the transaction. And then it spits out a receipt, okay? In the crypto world, the object is a crypto asset of some type. Smart contracts, tokenization are the technology for doing the payment, and then the blockchain is just the receipt. It's the record of the transaction happening. Those last two things are just technology. There's nothing to be afraid of from those two things. But they've been kind of blocked into this crypto thing, and so everybody says blockchain, and they freak out that this is terrible, oh my God. So it's, that's why we want to, like even at the Fed, the digital assets group that I kind of oversee, we spend a lot of time thinking about digital payments and how to use technology and what the possibilities are and how to innovate with these things. It has nothing to do with the crypto object. It's just a way of doing payments. So that's kind of how I look at it. Whatever the crypto object is, knock yourself out. Like I said, people spend $1 million or more for a baseball card. Go ahead. I'm not going to, but you're free to do it, buy whatever collectible object you want, and that's your choice, and there shouldn't be a lot of opposition to it in some sense unless there's real danger involved.
So you're focused on the crypto from the rail side, the payment side.
The rail and payments, that's for me personally, that's what I view as my lane, and that's what I'm trying to stay in.
Do you think the Fed has a good sense, and because we think about this a lot from our research side, of how much crypto is being used in payments? Sometimes it's hard to understand this data and close to real time.
Well, I think if you look at the data, almost all payments in the crypto world are done with stablecoins, right? There is always a medium of exchange that becomes the common standard for how you do payments for whatever object you buy, going in or out of exchanges, and that's kind of what happened with stablecoins. So right now they're mainly used in the the Ethereum world, and that's a completely separate set of rails from what we do on our day-to-day life. But someday those rails may interchange and figure out a technology that you can move back and forth across these relatively easily.
I'm going to go to central bank digital currency in a moment, but there's 7 or 8 questions online on the crypto front. You're going to be shocked to hear this, about the idea of a Bitcoin strategic reserve.
I leave that to the government to deal with. If they want to create a strategic reserve, first of all, then whatever objects they want to buy, that's not my problem.
Okay. But it could become part of the Fed's responsibility in theory.
Oh, no, I don't think it would be. I wouldn't be running this. I don't think. I haven't heard that.
Because part of the legislation is to sell gold, Fed sell gold certificates to pay for the purchase of Bitcoin.
I mean, I guess you could if you wanted to.
Yeah.
Like I said, I just don't have any comment on it.
All right, let's go to central bank digital currency. I want to put another chart up here. So this is a key area of research for us here at the Geoeconomic Center. And what we've shown over the past how 4 years we've looked at this is we started with 30 countries exploring CBDC. There are 130 now, but not all of those are in a serious form of exploration. There's sometimes what we call CBDC FOMO. Central banks are just saying, hey, should I get into this? We estimate there's about 60 countries that are in a serious phase of CBDC exploration. They've gone past research, they're in development, pilot, they're putting real resources behind it. How do you see retail CBDC, just from your perspective? We know where things are domestically, but just as a concept of retail CBDC.
Yeah, so I gave a speech back in August of 21 when the FOMO was everywhere, that everybody had to have a central bank digital currency. And I did what I think a standard economist would say, which is, what is the major market failure in the payment system that requires this object, and only this object, to solve that problem? That was a question I posed in August 21. Just tell me what you're fixing. What's the problem you're trying to fix with this solution? And no one's given me a really good answer in almost 3.5 years. So I kind of look at it, and what I argued in the speech was, if you look at the US payment system, it works incredibly well. I don't know what you're going to gain by having the Fed step out front and start dealing with the retail customers in terms of payments. So let me just rephrase this. Since our founding, which we talked about, we've taken a very straightforward model of the payment system. We will be in the back of the house, and we will let the banks deal with the front of the house and all the retail customers. And then we'll sit in the background and make sure all the money flows between the banks. So what I would like to know is, what is wrong with that model? What has changed that requires the central bank to now get out in the front of the house and compete directly with the banks? I just don't see the case for that. So that was what I did in the speech. I didn't see really what this was solving. Now, if you have a bad banking system or unreliable or some other things, then maybe you might. I'm not saying it's for everybody shouldn't do it, but you got to identify the problem. Just don't start throwing stuff, like an infomercial. Look, we got a CBDC. We can do this. We can do that. We can do this. That's what infomercials do. It minces, it dices, it mashes. And the whole point of an infomercial is to make you avoid asking the question, do I really need this thing? And that was the FOMO that was going on. And I think since that speech, I think a lot of central banks have stepped back and started asking, okay, why do we need this thing? They may come up with a good answer for it. But to date, as you said, only a handful of banks are even seriously talking about doing this.
Yeah, there's 3 fully launched, 9 pilots. Of course, China, we consider it a pilot, but 200 million users, so that's a big pilot. I want to talk about the digital euro in particular, because they seem to be moving forward from an ECB perspective. I think they're going to go in, we consider them in pilot, but they're going to do real live use testing pilot next year. Digital yen moving forward. Bank of England has said they want a digital pound by the end of the decade. So my question is, if we get to 2030 and there is a digital euro, a digital pound, and a digital yen, does that matter for the Fed?
No, they're basically going to do an account-based CBDC mainly. When you go to your bank, you can have a checking account that's backed up with commercial bank money, or there's a checking account that's backed up by CBDC. So you can pay your electric bill with either one. I don't know what the big deal about that is. It's so important. But one of the big reasons the ECB has announced that they are going to do this is that they want to directly compete with the private sector to drive down payment costs. That's a philosophical point of view. My view, and what we've always done in the US, is the government and the central bank, we do not compete directly with the private sector. That's not our job. We do not use taxpayer dollars to go out and directly compete with the private sector. That's purely a philosophical point. So the ECB is free to do whatever they want but that argument would not fly in the US, I think, very well.
And the international standards, this is something we hear a lot when we talk to central banks around the world. They're trying to figure out how to do privacy in CBDC, offline payments in CBDC. And sometimes, even though the US isn't going to do one domestically, they wish the US was there to help them answer these issues. Is it anything you think about from the Fed's perspective about all these CBDCs proliferating around the world? We might not have one, but we might be interested in how these others operate.
Yeah, the privacy thing, again, this is a technology issue about how you set the thing up. So, for example, when all we do right now is we get a notice from Bank A, make a payment to Bank B. I don't know what it's for. I don't know who initiated it. I just get Bank A says, move some money from my account to this bank's account. You could do a very similar thing with CBDC in the sense that I don't know why the CBDC is moving. I don't know who's sending it or what the transaction was. So in that sense, there isn't any real privacy issue. But a retail CBDC where you have a direct account with the Fed, I'm going to see everything.
Right.
And that is another reason for privacy. Despite the fact you would have to have access to a master account, which we're not allowed to do, so Congress would have to change. But that's what I mean. There are ways of doing this that you would have some privacy protection. But this is just in general now a huge issue in the payments world is how much privacy do we need in terms of payments, particularly when you're trying to think about illicit finance, anti-terrorism, money laundering. You got to have some visibility into the payments if you want to do those things.
Now, I remember a few years ago there were all this talk about direct Fed accounts. I think every central bank in the world has said if they have a CBDC, they're going to intermediate it for all the reasons that it doesn't make sense. I don't think central banks are great at being customer-facing institutions. That's not their remit. But let's talk wholesale CBDC because that's a different ballgame. And there we're talking about cross-border payments between banks or domestic payments between banks. And sometimes the nomenclature I think gets a little confused here between the retail space, central bank digital currency, and wholesale, which is a very different kind of question.
Yeah, so in fact, at the Fed, we've dropped this whole language of this term wholesale because we already have a central bank digital currency wholesale, which is called bank reserves. It's digital, it's how the banks settle up and pay, and we've used it for decades and decades and decades. There's nothing. So unless you're talking about creating a new central bank liability, we already have it. Now, the better thing to do is think about how you can use technology to improve on the payments, how we do it, how banks can use their reserves to settle in a better way. That would be tokenization or platforms or blockchains. You can think about banks trading reserves in a more efficient way. Certainly the correspondent banking system could be done better, but it doesn't mean we create a new liability. It's just how do you take the existing liabilities, use technology to move money faster and safer.
And the U.S., I think, has a vested interest, it's fair to say, in being part of that improvement process. And our commercial banks are interested.
Yep, they all are. That's very different than creating a new liability, a central bank liability. So we've dropped this whole nomenclature at the Fed on the retail thing. We don't talk about it. We just say we do digital payments, which any object can be used for that. Bank money, whatever. We're just trying to understand how digital payments occur.
Just to put a practical example on that, you have a bank, they want to tokenize their deposit, that's their choice, and they might have a master account at the Fed, but how they transfer it cross-border, that's between them and the banks they're working with.
Yeah, I mean, we used to do checks. Well, the people still do, or we should all stop. Debit card. There's all kinds of ways that the banks tokenize their deposits and move money across, in a sense. How they do the payment, just how they do the payment. But in the back end, it's still just us moving the money back and forth across bank accounts. That's it.
So is the U.S. then still involved in Project Agora? Is this, that's
Agora,
not a whole...
Or Agora, however you say the word.
The BIS always corrects me one way or
me
the
too.
other. So I feel like I do it one way and then they say it's the other. However you pronounce it, I'll pronounce it. So
yeah, I mean, that project is really not about creating a wholesale CBD. It's like taking bank reserves that we have now, and how can you trade these on a platform to cut out intermediate steps, make the correspondent banking system more efficient. We're not trying to replace anything. We're just simply saying, when you think about the correspondent bank, my bank goes to this bank, goes to that bank, goes to that bank to get a payment to somebody in Italy or Switzerland. Can't we do that a little more efficiently and faster without all these steps? Can't we get the banks somehow all tied to the same platform so that we don't have to do the intermediation across several banks? I mean, this is just about efficiency. This has nothing to do with the liability itself. It's the same liability. It's just how do we make it move faster and more efficiently?
So the New York Fed will stay involved in that project?
Yeah, I mean, that's really about correspondent banking. That's not about wholesale CBDC.
That's helpful.
Like I said, we completely have stopped using this word, this nomenclature, as you put it.
So let's talk more international on the BRICS side. This is a big area of focus for us. We run the Dollar Dominance Project here at the Atlantic Council, CBDC Tracker. We talk about SIPs and SWIFT. There's a range of countries, but China in particular, who are building alternative financial networks. China's Enbridge is a wholesale CBDC project. They have their SIPs network, which is not CBDC, it's just traditional settlement and messaging.
Yeah.
How do you think about that from the Fed's perspective? Does this challenge the dollar in any way or challenge our financial networks in any way?
Well, it's one of those things, if a group of countries wants to sit down and build a new financial platform amongst themselves, I can't stop them from doing it. The question is, why does anybody want to be part of it? Because right now you have a very broad global system with the largest economies in the world and access to them. So what are you really gaining out of it? Now, if your trade is all local in Asia and you don't really care about trading with the US or Europe directly, well, yeah, I mean, then knock yourself out. But if you want to trade with Europe and the US, which is like 40 to 50% of the US or the global economy, then you're going to have to get off that platform and potentially trade with us in some common platform that we use. And then you just ask, if you take these countries, what is the point of being on those platforms? What are you trying to accomplish by getting off of the dollar and getting off of our platforms? What we want to be able to do is make sure that we have a valuable product that other countries and everybody else says, yeah, I'd rather be on that one than that one. So it's really about what is the value proposition you give to countries for your payment system, and that's really it. That's the end of the day.
Does that mean that we need to upgrade SWIFT, some of our settlement and messaging cross-border systems?
There's always updating. We got new messaging, the ISO 20022, which is an international standard. It takes time for everybody to agree and cooperate on those standards. It doesn't always happen overnight, but there's always technological improvements you need to do. That's the only way things always get better. That's true of any product on the planet. So I don't view that any differently, for payments any differently than anything else.
I'm happy to say that, because we often, and Washington spends a lot of time kind of wagging their finger at Enbridge and these other developments. But in the end, if the dollar and the euro are working together on these issues, I think no country can afford to be outside that system.
Yeah, like I said, if they do this and you want to join them, what are you getting out of it? That's really what I want to ask, and I'm trying to make the case that it's better to be tied to us than no.
I mean, I think sometimes the answer would be that people would say privately they're worried about sanctions or geopolitics. They're trying to find a hedge.
That's outside my wheelhouse. Yeah. Talk to the Treasury and everybody else.
We will do that. I want to talk about a speech you gave in India. It was an interesting line you had. You said, "Not all frictions that slow payments down are bad." And I wanted you to just explain that a little. It goes to what we were talking about before about technology and policy.
Right. So, the point is, we want cheaper, faster payments, but we also want the payments to be safe. Okay? That word often gets lost in all the general dialogue. Is faster, cheaper, and safe. That's the critical part. Now, what is safe? So one, there's just technology that the payment system doesn't crash. That's just an operational kind of safety. We, in general, have certain principles. We don't think we should have payments that are just money laundering. We don't think they should be financing terrorism. We don't want them to be fraudulent. So, for those things, to make sure that they're not of those types of payments, which we have to choose as a society whether we want to have that or not. But if you're going to say we don't want those things, then you need to slow down the payments to make them safer, that you can stop them or unwind them. But then that means they're not going to be quote unquote fast. So there's sometimes a trade-off between fast and safe. And that's a critical. I mean, I like to drive 100 miles an hour to get home, but it's not safe and nobody wants me to do it. Yeah. But it's exactly that kind of idea, that you have to trade off safety. You have to trade off speed for safety sometimes.
Yeah. No, I think it's such an important point in payments, because we focus so much on the technology, and there's reasons why payments don't happen instantly.
Correct.
Doesn't mean they can't happen more quickly, but maybe instantly isn't the safest option.
Yeah, you want to keep them safe, but speed up the time that you can do all the safety checks just faster.
Okay, I'm going to ask you one more question, then we get to the audience questions with the 10 minutes we have left. It's about the G20. So South Africa hosting the G20 this year, and then the US will be the host of the G20 next year. I wanted to hear about the Fed's engagement in the G20 process, the international engagement, and what you hope to get out of that process with G20 partners.
Right, so the main thing with the G20 process is trying to have cheaper, faster global payments around the world. As I just said, one of the things I've been trying to emphasize over and over is that it's not just cheaper and faster, but you want them safe. Okay, that part's got to be in this. The other thing is, there's this sense in which India's got their UPI fast payment system. Brazil has PIX. We have FedNow and RTP. And the idea is, can't you just take a cord from that one, a cord from this one, and get an adapter, put some tape around it, and turn it on? That's not how it works. It's not that technology. The biggest problem is governance. What are the rules that you're going to use for doing these payments? What's the standards for messaging that you're going to do in these payments? These things take time to negotiate, work out, and solve. There's legal restrictions within countries in terms of how you do things. So that's my point is, these are not just simple technology, plug two cables and flip the switch and there you go. It's a lot deeper than that, and it takes more country cooperation. And as we know, building up country cooperation, agreeing on standards for all these things just takes time. It's not anything you can snap your finger and do.
Okay, I'm going to get to audience questions. The first question is kind of a forward-looking question. What do you think the ecosystem will look like in the US in 5 years between stablecoins, commercial bank money, and digital assets?
Well, yeah, I think commercial bank money is going to be around. We still use it. It's functional. It's what we're comfortable with. It's what we know. Trust me, that familiarity is a big thing with people in terms of like payments. This is why some people still write with checks. That's just what they've done forever. That's what they feel comfortable with. Even if you tell them that's not very good, it's not efficient, it's not safe, that's what they're familiar with. So, what'll change? Well, I don't know what'll change, but we use our our commercial bank deposit money all the time in all the payments that we do, and it works very well. So it's kind of hard to say I'm going to just throw it aside. What I see with stable coins is just it's going to open up possibilities and other ways of doing payments, other rails. You may be able to go into a store, and instead of paying with your bank account, you pay with your stablecoin account, whoever's managing that. And it'll just be the same process. It's just which of the accounts are you paying out of. So in that sense, I just think of the payment world is going to just open up things broadly. I've made this joke many times. I'm going to repeat it, but who would have thought 25 years ago that payments would have been one of the coolest tech jobs in the United States?
Everyone's talking about payments.
Right. Everybody used to be some guy with a visor and a pad, right? And but it's the technology part that makes it really exciting. But that's also means there's so many things that can happen through innovation that I never thought I'd walk up and tap a phone on something and pay for stuff. I mean, that was unheard of 20 years ago.
Well, I guess the follow-up then is just about cash usage. Where do you see that heading in the U.S. over 5 or 10 years?
Well, it's clearly going down. I don't know how many of you, I haven't used cash in the U.S. in probably 18 months. I haven't used it in Europe in 3 years. I mean, I just don't use currency. Everything's digital, it's electronic. Yeah. But there's huge demand globally for physical cash. We print currency in the US, it grows, demand grows at 7% a year, 6 to 7. It's just like amazing. Just keeps right on going. We saw during the pandemic that there was a dash for physical cash. People didn't trust necessarily that, I don't know what happened. I can't explain why people did it, but there was a massive run on banks and us to get physical cash. People like just having the store of value. You say, well, it's in your bank account. It's electronic. It's all safe. I want the physical cash. Okay, here you go. So I don't think it's ever going to go away for that reason. People have, some belief they want to hold on to it. But we clearly see it declining in terms of its share of payments. It used to be it was the big fraction of payments, but they were small. That fraction is getting smaller and smaller in the U.S. Yeah. So there is a point we may be purely digital and there won't be that much currency out there.
And then there won't be, without a CBDC, a kind of...
We'll just keep using stable coins and everything denominated digitally, just like we do now. I mean, most of the stuff we do is digital and there's no physical cash.
There's a question here. You mentioned PIX and UPI, and I think it's worth clarifying because the question is about FedNow being behind PIX and UPI in terms of adoption, but I don't think you see them as sort of competitors in that space.
No, I don't see them as competitors. I mean, so, when I went to India and I spent a couple of days talking with tons of people about payments and everything, it's a QR code based system. Right? You have to pull out your phone, you take a picture of a QR code, you do some stuff, and it makes a payment. In the US, we just tap and go. I don't have to pull out my camera, take a picture of something. I just imagine doing this at the Metro. I mean, forget it. You just walk up, you tap and go. So there's an advantage. The problem with India is they did not have a card-based bank account system. My apologies to anybody, but this is what if I roughly remember. Prior to UPI, something like only 100 million people had bank accounts. It was a physical cash economy. And so what you did with UPI was you replaced the cash economy with a digital economy. But it's kind of like us with debit cards. The average transaction in the UPI is like $50. These are not large volume transactions. They're just small denomination. You replace currency with a digital payment. We did that a long time ago. That's not some big advantage. So I don't really see this as something that's going to technologically dominate what we do. We're a heavily banked society, and we have a card-based system that's worked well, and it will continue to work well. So I don't really see it as a competitor for us.
The question here now on stablecoins, and I'll put up a chart, actually, it's related to this. The question is, are we behind on regulation of stablecoins, given that stablecoins are all pegged to the dollar? I'm summarizing this question here. And we have our research here. This is our cryptocurrency regulatory tracker for anyone who wants to check it out, showing where the US is versus some peers. Is this an issue from your perspective? And maybe we'll have some more clarity soon.
Yeah, I mean, I think this is one thing, like I said, I view stablecoins as a net addition to our payment system, but I gave you some reasons why you might want to have regulatory rails around it to make sure the money is there, it doesn't break the buck, who's authorizing and who's checking to make sure it's fully backed, that kind of stuff. And we don't have that, and we need it if we want to have the option to do this. This seems to be a bipartisan issue. There's legislation currently being talked about. I'm not going to talk about it because I haven't read it all, but I think it's clear that people see this as something to go forward with, and both parties are moving on putting in a framework.
Two more questions I'll get to here. There's a lot online, more on Bitcoin, but I won't ask you any more about that. But on this question is about payment strategy, and the question is about, in the UK, they have a general payment strategy. We've talked to the Bank of England extensively about this, how commercial banking liabilities and digital assets work. Do we have that in the US? Do we need it in the US of where we want things to go? And obviously that's not just a Fed conversation.
No, exactly. That's exactly the point. The payment ecosystem is us and everybody else. So I don't like, how should I say it? I'm not a big believer in saying the Fed should lay out the strategy for the payment system and that. No, this is not something, like I said, our job has always been kind of to make sure it works, that the private sector does a lot of it, and our job is just kind of to coordinate and fill in where we think there's some gaps. But like with real-time payments, that's what we did, I think, back in 2015. We sat down with all the banks and kind of said, look, we should move in this direction, and we were more the coordinating device that brought people together. But then we turned it loose. The banks did RTP long before we did FedNow. So I'm a big believer in not grand strategies, just sit down and talk. What are the problems? What are the issues? Try to if there's something that I play a coordination role in, I'm happy to do that. I think that's important. But other than that, I'm not a big believer in big grand strategy. Do we have our own strategy for how we're going to do stuff with Fed? Sure we do. Of course we do. But we're not going to impose what we're going to do on everybody else.
Okay, there are multiple questions on this issue, and I think it's an appropriate one to end on. Is there anything in your mind that could challenge the status of the dollar as a global reserve currency? I'm weaving a few questions together.
Right. I guess that's the thing is I don't see this happening. The U.S. is the most vibrant economy in the world. You just look at it compared to everybody else right now. We're the largest economy in the world. We do not force people to use the dollar. This is one thing I really try to stress. We don't force anybody to use the dollar. It's their choice. They voluntarily do it. A Japanese firm and a German firm, when they do a trade, they do it in dollars. We don't tell them to do it. They just would prefer to do that. So there's a reason for that, which is we have deep liquid capital markets, certainly for treasuries, which is the ultimate backstop for a lot of this. Good connection to the economies, rule of law and justice in courts. These are all things that everybody kind of believes in why this is a good object. So it would have to be the case that somebody would wake up and say, there's somebody else offering that better than the US. And I don't see that happening anywhere on the horizon.
I think that's a good note to end on. Governor Waller, thank you for joining us at the Atlantic Council today. Please join me in thanking Governor Waller. We will continue our